Everything that I do is couched in the school of thought of intermarket analysis, which is the relative movement of different asset classes and sectors within those asset classes might show you the whites of the eyes of regime change to come.
Because you get these clusters of things that you've studied and how they work together. You have the discipline to get out. You have another signal to get you back in.
That's Michael Guyed, portfolio manager of the 8-TAC funds with Toroso Investments, and Clara Basile, who's co-founder, CEO, and portfolio manager of Avalon Capital Management. I'm Dave Armstrong.
I'm Dan Weiskopf. This is the Think Tank Exchange podcast, and we're asking the question, are you prepared to be risk on, risk off for your clients? Thanks for joining us. Hello, David. How are you?
Dan, I'm doing great. How about you?
I am, especially because we've got a great show for our audience.
I'll remind our audience that the focus here at the ETF Think Tank Exchange is to provide thought leadership by bridging the gap between investment producers and the advisors who use their products through actionable ideas.
Well, we're coming at this risk on, risk off conversation by talking about the value of research and finding trusted and reliable information. Our guests will share their investment philosophies, and then we'll hear interesting views on how to search for signals for when to be risk on or risk off. So a lot of great insights coming your way.
Then Dan and I will have key takeaways, as well as highlighting a charity that Clara Basile believes that you can too. But now let's dive into this podcast with Michael Venuto, Michael Guyed, and Clara Basile.
I kind of want to dive deep into the important aspects of research, right? I like to make the joke that the only thing that separates asset managers from researchers is assets, right? But it's more than that, right? Because it's more important that you separate good research from noise.
Now, from my perspective, look, I know a lot of people don't like back tests. But I don't know any other way that you can test the merit of any individual idea or signal. I used to always, when I was on the road presenting at CFA chapters, I think even Clara, when I was presenting at the CFA San Francisco chapter, I made this point that, a lot of people don't believe in back tests, but they believe in buy and hold. But buy and hold is a back test, right? It's a back test with one trade, right? The buy, but it's still a back test. So for me, as somebody who puts out quite a bit of research and has put out these 5 different white papers that won these different awards over the years. The key thing is to actually take a deep dive, actually write it down, try to be objective and try to be quantitative, I think, in whatever you're going to hang your hat on, because the reality is, again, there's a lot of things that people say, but I think from a research perspective, unless you can actually test if it produces alpha, it's largely just noise. What are your thoughts on that, Clara?
Well, absolutely. And I think you also have to consider the data set that you're using. I think a problem with a lot of back tests is that they're too short term. I will have vendors come in all the time to the office and they want to show me their back test and why I should use their indicators. If you're using 10 years of data, you're capturing one cycle. The power of in our process is that we're using data as far back as it goes. And the point of this is, you're talking about the buy and hold bias. I'd say there's a buy and hold bias in stocks, but there's also a buy and hold bias relative to a 60-40 portfolio, 60% stocks, 40% fixed income. Well, there are distinct periods historically where that portfolio just did not work. And of course, the 70s being the most obvious one where inflation was out of control and your real return is negative. So I like to think about, back testing is not for me a black box, but it is a tool to help me pair what the quantitative research is saying with what scenario analysis we've done, which is, multivariate analysis, and say, does this make sense?
I love this because one of our investment tenets is data without context is irrelevant.
Well said.
Let's just dive a little deeper into, once you have a concept, how do you test it? How do you document it? And Guyed, why don't we start with you and then we'll come to Clara for her thoughts on it.
So look, I think actually that's a really, you bring up a really interesting and important point, which I think ties into not just sort of the robustness of a research finding, but also the credibility of the person writing it. When you put research out there, you write it down, you quantitatively test it. And in my case, having won these 5 different awards for these 5 different research papers, basically I'm exposing, the intellectual capital to the world to your point, see if anybody can poke holes at it, which should actually make it far more anti-fragile as a finding, using a Nassim Taleb type word. And I think that's really important, right? Because it's like, it's like almost like open source code. Right? How do you get something to be very anti-fragile? You have to expose it to as many people possibly trying to hack it as possible, right? So, and I do think that there's a certain amount of truth with oneself when you actually sit down and write and do research, and it's just you and your keyboard or you and a pen and paper, because if you're fooling anybody, you're only fooling yourself at that point, right? With what you're actually trying to document. So I do think that there's a lot of merit to that. And I think that's also where backtesting is important, to Clara's point, as a tool, because it's a tool to help you validate if what you're thinking actually means something, and then makes you think about the causation as a result. So I think it is, for me, I'm quite proud about that, to be peer reviewed with these white papers by other advisors, other managers who do anomaly-based or factor-based type investing, to have those peers recognize that this is real, valid research, I think is a testament not necessarily to the finding, but to the thinking that goes into uncovering the finding, as opposed to just straight up data mining.
And right now, I think it's more a risk for investors than I've seen probably in 20 years, since 99, 2000, when everyone had an idea about stocks. So, finding some solid ideas, writing them down, testing them is my recommendation for a lot of people who are just beginning to do this. And we actually evolved our process. I wouldn't say we changed it, but we had this 6 mix approach where we said, if you use these 3 buckets, which we break into 2 pieces each, you can come up with a return that is good in any environment for less risk than the conventional 60-40 portfolio. And so we embarked on an entirely new research process that layered on 28 years of research to make it more rigorous, more quantitative. And we call that ADA, which is the Avalon Dynamic Allocation approach. But I just want to tell you, having this solid core understanding of risk-return relationships that we had built over all these years, and pairing that with our scenario analysis, adding that rigorously tested quantitative layer in ADA has catapulted the returns relative to the risk that we're taking. And again, that risk factor is always the foundation of everything that we're looking at.
All right. That was some deep thoughts on research. And I really appreciate it. So from there, I want to move to our next section and start to talk about some of the investment philosophies that you've kind of hinted at through the research, but now let's get into what they actually are. So Guy, why don't we start with you and you just talk about your overall intermarket analysis concepts and whatnot. We'll do the signals in the last section, but just talk about your investment philosophy. And then Clara, I want to come to you to talk about how you evaluate something like that, because, advisors are really lost on how to look at things that aren't fitting into the normal 60-40. So Michael?
Everything that I do is couched in the school of thought of intermarket analysis, which is the relative movement of different asset classes and sectors within those asset classes might show you the whites of the eyes of regime change to come. And so, when you kind of have that mindset that this relative movement of asset classes and sectors might show you something that people that are only focused within a particular asset class may be missing, now that opens up a whole different line of thinking in terms of what types of anomalies, what types of information, what types of leading indicators can you then follow that maybe others that, again, are centralized on just a particular asset class are missing. And all of the all the papers in some way, shape, or form are tied to the idea that one part of the marketplace moves first. There's a lag in terms of the diffusion of that information to another part of the marketplace, and that's what's really exploitable. So it's a very different sort of mindset, and it's not really fundamental analysis driven, right? It's sort of using the actions of investors in a particular asset class as a tell on what it suggests for future growth and inflation expectations.
Okay, so Clara, when you take these concepts of intermarket analysis and create a strategy that has a return stream that's neither correlated to bonds or equities,
right,
how do you incorporate that into an overall client total portfolio solution?
Well, again, I'm going to have to go back to what we do and
that's what we want to hear.
using this 6 mix, you will find that what is going to be strongest among those 6 asset classes is really going to be determined by a lot of what Michael's already alluded to. What is the direction of interest rates? What is the direction of inflation? And then you try to find what are the things actually in the market that can show me what the story is. So every market is telling you a story about the environment. I think a lot of, economic work does it in reverse. It says, what are the economics, which we all know as more quantitative managers, the economics tend to lag what the markets already know. So part of it is that markets are forward-looking. They're discounting a future reality. So if you are relying simply on economic data to tell you what the story is, you will probably be too late to the party. I mean, if you are relying on the market data and you recognize which market inputs normally give you information about other markets, then you're going to be ahead of the curve. So, in our process, there's a huge weighting on what we call secularity, the very long-term trend. So I know in Michael's work, he's looking more at shorter-term pulses, but those pulses are telling a story. In our work, the secularity or these very long-term trends and cycles are telling us a base case story. And then we are looking at these intermarket relationships to say, are they supporting or refuting that basic story? Now, there's a signal component to this as well. We're using trend and cycle and regression, which is a very important concept because what you pay matters. This whole notion of let's go back to the bonds because it's clearly the elephant in the room right now. Everyone thinks bonds are low risk. Well, are bonds low risk if the price is too high? No. Or I'll give you an example of last March. I mean, are stocks high risk when on a regression basis, they were as depressed as they had been back to 2008, which was an optimal time to buy. So you have to recognize how to what the interplay of these various metrics are in terms of what they're telling you about where you're going next in the next 6, 12 months. I think as you go further out, it gets harder to predict. So there are some clusters.
That's why we have futures curves.
Yeah, exactly. Because you get these clusters of things that you've studied and how they work together. And by the way, they don't always work exactly the same way, but there is enough repetition in how they work that we go back to this original concept we talked about. If you've tested it and it's worked many times, you may have many bad trades and you lose money, but you have the discipline to get out. You recognize it's not working. You have another signal that takes you out, right? And then you have something that gets you back in.
Yeah. All right. So I want to move into our last investment section because we've now covered the importance of research. We've covered the concepts of intermarket analysis. Clara, you've helped us cover the idea of alternatives to that 60-40 model and the implementation of ideas like this. Now I want to get into actual signals. I've got questions in the chat about signals on Bitcoin, on silver. Gayed, you've written tons about gold versus lumber and treasuries versus utilities. Why don't we start with you on some of the key signals you look at, and then we'll go to Clara for some of her signals or conditions. Let's go there.
Yeah. So taking a step back, right? I think understanding what signals are designed to tell you is really important. Right? So a lot of people think, for example, that a moving average tells you about trends, up or down. The 2016 Dow Award paper titled Leverage for the Long Run documents the idea that moving averages don't tell you a damn thing about trend. What they do tell you about is volatility, right? So a lot of the work, at least from my mindset around signals, are less about when to get in, but rather when to de-risk when the conditions favor the asset. Most high volatility black swan tail events tend to occur when you're below a moving average in the S&P, when utilities are already outperforming the stock market, when long duration treasuries are outperforming intermediate, when lumber to gold is weak. So, I think part of the discussion around signals is also sort of a discussion around what is it that you're trying to achieve. And I always make this point that if you're going to be tactical and you're really going to try to generate alpha, you do that by recognizing that if you want to kill it in the stock market, you have to not get killed, which is really what most signals ultimately that have any sort of historical merit tell you about. And there's a reason for that, by the way. The reason why signals should tell you more about down capture and avoidance of big declines than up capture is because declines are relatively rare. So you can play signals all you want. The reality is, for most, it's better to just be buy and hold rather than be tactical, because if you're going to be tactical following signals, you're going to get a lot of false positives. A lot of times where your signal says to get out and the market keeps going higher, you slow down entering the storm. You don't have the accident. You get to your destination slower. So I think that's kind of an important way to think about it. So, I look at things kind of very simplistically in that sense that if the most powerful predictors are things which are really what drive capitalism, which is the cost of capital, then you focus on interest rate sensitive groups to determine your signal for when to play risk on offense, when to play risk off defense. And again, the caveat there is that most of your performance comes not from the risk on side. It comes from avoiding the major tail events, getting the risk off position right. And even though you could be wrong a number of times along the way playing defense, the one time you're right, it saves your life.
I'd like to add to that, Mike. It's great. Yeah, I mean, you've hit on so many topics. I'm going to use the simple one for the listeners, which is, taking just the sectors of the S&P, for example, and you break them into buckets. So, Ned Davis calls it the SHUT index, which is staples, healthcare, utilities, and telecom. And if you look at those relative to a bucket of more cyclical sectors, and just look at which bucket is doing better, it is telling you in itself, are we in a risk on or risk off environment? And of course, if you look at the current moment, the staples, healthcare, utility, and telecom. Well, the telecom's a little bit different from historically because that whole index has been changed quite a bit. So what we call the communication sector is actually doing quite well. But you've had a terrible period for staples and utilities in particular. Now, healthcare, if you break it into the biotech, of course, has been roaring. But in general, if you just say, how are my safety defensive assets doing versus my more cyclical assets doing, it's telling you something about environment. So that's a very simple example of what we would look at in giving us some, and then you pair that with what direction are interest rates going. But I agree with you. Interest rates really are the beginning of the analysis because everything is indicated by the direction of interest rates, and the yield curve. I think would be another thing that's the yield curve and whether you have negative or positive real interest rates. So, when you're in a negative real interest rate environment, as we have been, risk assets tend to perform very well. Gold tends to perform very well. If you look at this current, since about August, when, real rates were extremely negative, and as the 10-year started to rise, they got less negative. So the other thing you have to think about is the direction of the indicator. So just absolute levels aren't always as important as the direction of the change. And that will also give you information. You can also look at the relative interest rates globally to give you ideas about what currencies are going to do. So currencies are also going to give you information about whether you should be favoring U.S. over international, whether emerging markets are going to do well. If the dollar is really strong, emerging markets tend to not do as well. If the dollar is weak, emerging markets do well. So these are some of the kinds of things that are in our model that give us more information about the allocation and where we should do our overweighting, not just among the asset classes, but within the asset classes. So, another example would be, as the real yield was actually starting to get rising since August, you saw a real divergence in the commodity sector where gold went dead, but the more cyclical commodities took off, and particularly oil. So again, as Michael said, oil, if interest rates are starting to go back up, you saw a 10-year at 50 basis points getting up to 160, on a rate of change basis, that's a huge move. And you saw the throughput in how the commodity sector has played out.
Dan, I thought this was another great show and emphasizes, I think, the importance of being able to have a plan and knowing how to pivot when conditions in markets change.
It takes a lot of the decision making away from being emotional. And for clients and for financial advisors, I think that's very helpful, because it becomes automatic.
I agree. I like what Michael talked about with his research, because to me, the essence of research is really being able to think more deeply about how markets operate. And at the end of the day, that's what every advisor is looking for, a manager that they can have confidence in, because they know how to see things that the advisor may not be able to see themselves.
Yeah, because things are going to change. We know that, right? The old 60-40 model is broken. Now, how you deal with it is the question.
Dan, I think you're spot on, because a good manager who has their research is going to look for signals. And part of what I think you point out is the fact that the signals that people have also are dynamic in and of themselves. There are factors that managers look for in their strategies, and those will persist for some period of time, but it's also important to be able to look out for other new signals that come into the market as well.
I like what Claire was talking about also about diversification. That will be critical when the conditions change.
I agree.
So we always like to end our show with an idea from our advisor guest on a charity that people should consider. We encourage you to give, but it's more important to also just know. So Clara, you want to bring us to the end here with the charity that you want to share?
Yes, I'd like to point everyone toward onefairwage.site. One Fair Wage is a national coalition that is trying to bring the minimum wage to service workers, mostly tipped workers. So restaurant workers, hair salon, nail salon, delivery, those sorts of businesses. And across the country, more than 30 states, you can still earn only $2 to $3 an hour plus tips. And the notion that someone could live on that needs to be challenged. I know there's a lot of debate about the minimum wage in this country, which is a complicated subject as to what that number should be, because it probably needs to be calibrated by region and cost of living, which it isn't right now, which is causing some problems in terms of getting this passed. But as far as just the tipped workers should at least be getting whatever the basic minimum wage is. So if you check out One Fair Wage, I think you'll find they have a very interesting story. And they've also been providing some funds for those who have really suffered during COVID because they haven't been able to even do their jobs, particularly in the restaurant industry.
Beautiful. Thank you so much.
Thank you, Clara.
Thank you. This was fun. I enjoyed it.
We promised you it would be fun.
So as we wrap up, we'd like to thank Michael Gayed, Clara Basile, and Michael Venuto for their insights. Learn more about One Fair Wage by visiting onefairwage.site.
You can learn more about the ETF Think Tank and the Think Tank Exchange by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
That's because our value proposition is to enhance yours. I'm David Armstrong.
And I'm Dan Weiskopf. Keep the exchange going with your clients. Until next time, take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.